Greetings, my beloved clients and friends. Coming to you live from the beautiful island of Bora Bora. I want to do a video that I actually tried to do about a week ago, but it didn't come out quite right, so I'm going to try again. So we're talking about identifying characteristics of 10 baggers, and we did a video on qualitative characteristics of 10 baggers. We talked about having a founder CEO. We talked about having raving fans, and at the same time strong opposition on the other side. And we also talked about having a disruptive technology and as some identifiers of potential 10 baggers. But I want to talk about some more quantitative identifying characteristics this time. Stuff that you would find on the financial statements, okay? So more numbers oriented. And so I want to give you two metrics. One is strong revenue growth, okay? So we want a company that has been growing at a rapid clip in the past and has a strong potential to continue to grow at a rapid clip for a long time into the future. Okay, and we want to see revenue growth north of 20%. Okay, so not many companies are going to meet that hurdle, but we're not looking for many companies. We just need a few, and there are a few. Sometimes they're in a category, in an industry that has a lot of potential. Like, for example, Tesla. The auto industry is huge, and about 1% of it is electric vehicles. So they have the potential to grow into that industry over many, many years. And Elon Musk even said last year in one of his quarterly calls that he sees the company growing at 50% a year, or at least 40 for the next decade. Okay? And he reiterated that this year in a call. So that's the type of long-term growth that we're talking about. It might be because of a disruptive technology. They might be a category creator and a category killer, like Google, right? They created this category called search, and they own at least 80% of it. And they've been able to grow into that at a high rate of growth for many, many years. And it seems like that growth is continuing. Amazon is the same thing, right? Online retail, they almost created that industry, and they definitely dominated it. And it's an industry that has a long runway in front of it, that they could grow at 20% a year for many years, and they have, and they can continue to do that. Okay, so those are the types of companies that we look for. Very strong revenue growth. Now, analysts tend to look at the bottom line, which is earnings, and we're talking about the top line, which is revenue. So it's often overlooked or not given that much credit when you see this company with very high revenue growth. Amazon is a prime example of that. You know, they didn't make money for a long time. Profits on the bottom line, but their revenue was growing consistently around 20%. Okay, and analysts discounted that. They're like, well, but they don't make any money. And there was some truth to that. And so you look at their price to earnings ratio. Obviously, if there are no earnings, there is no price to earnings. And in the years that there was earnings, it was very small. So it was trading at 200, 250 times earnings, which analysts would determine that was ridiculously expensive. Okay, but the revenue growth was there, and the price to sale or price to revenue was actually quite reasonable. So why is it that these rapidly growing companies often don't show very good earnings? Well, it's because they're growing so fast. And earnings is basically the money that you have left over after you've spent everything. Okay? And so if they have a stable company is going to generate a lot of earnings, but maybe it's not going to grow that fast. But a rapidly growing company is going to need that money to grow, to continue to grow, right? So yeah, they're not going to show a lot of earnings, and that's not really a problem, because eventually they will. Okay, so a great example of that would be Nike. Phil Knight, the founder of Nike, wrote this book, which I encourage you to read. It was called Shoe Dog, and he describes the early years of Nike. And by the early years, I mean like the first 20 to 30 years of Nike, and how it started in his garage and became a global conglomerate. I mean, this is huge S&P 500 company, right? From his garage to that level. And it was a huge success, amazing growth through the 70s, 80s, 90s, and even through till today. But in those early years, the early 2030, they were always having a problem with not enough cash, that they needed to go to the banks, and the banks were reluctant to lend them because they were not showing earnings. So that's very typical of a company that's meeting with a lot of success. They have incredible revenue growth, but they have need for that revenue. They need to plow it back into the business, and by plowing it back into the business, that facilitates the continued growth. Okay, so they don't show a lot of earnings, and really earnings is only the money that you get taxed on. So why do you really want to have a ton of earnings anyway, if you could grow and pay all the bills and not have to pay taxes if you reinvest that money into your company? So that's one sign we look at is very strong revenue growth. Okay, we're not too worried about the bottom line for these companies with very strong revenue growth, and we'll explain why. And the second metric is low price to sales. Okay, because if it has great revenue growth, if it's growing great, there will be some areas of Wall Street that would find it interesting, and maybe they do see the potential and the future in this company, and maybe it's already priced in, right? Maybe this company isn't even making a profit, but it's trading at 25, 30 times sales or more. And that would be a company that really has already been discovered, that the future growth is priced in, and that maybe we would want to stay away from, even if it has great growth. It's just too widely acknowledged, and it's priced in that not only do they have great growth and great growth potential, but basically they have to deliver on that growth for this investment to even be viable, because all that future expected growth is already priced in. So we like to see companies trading at 1 to 2 to 3, or maybe at the most 4 times sales, and with that great revenue growth. So there you get a company growing great and trading not too expensive. Okay, and we've had a lot of success with that formula. For example, Tesla. It was a company that I was one of the ones that was a big detractor, a big naysayer at Tesla. Wow, they don't make any money. All they do is lose money. They're not going to make it. They were on the brink of bankruptcy in 2018. But then in 2019, they took another look at it. And lo and behold, they had been growing revenue at close to 50% a year for many years. The stock had done nothing, and it was trading at about 1.5 times sales. And I went into the office. I told Charles, hey, did you realize that Tesla's trading at 1.5 times sales? We got serious about looking at it, and we eventually bought it because of other reasons, but two of the big reasons was the amazing revenue growth and the low price to sales. Okay, another one that fit that category was Wayfair. Wayfair was a company that we really liked. We had looked at it in 2019 when it was trading about $150 a share. We thought it had great growth potential, but it was kind of expensive. So when the pandemic hit and the market sold off, this company really sold off. I remember at peak panic in the market, it was, I think, March 18th, I saw Wayfair at $23 a share. I said, what? But there was so much panic in the market that day, and a little bit it infected me, and I didn't buy it. And that was on a Wednesday. Monday morning, I saw Wayfair start moving up, and it had gotten into the 30s. So from the 20s to the 30s, like a 50% uptick. And I said, wait a minute, this thing's found the bottom, and we bought it. And it had like about 25% revenue growth. It was trading about 0.3 times sales. So that's what we liked about it, right? We liked the company, and then we liked the growth and the price. Another one was GameStop. Now, GameStop's revenue had not been growing. It had been steady at about $10 billion a year, and in the most recent years, it had come down to like $8 billion and $5 billion. So the revenue was going the wrong way, but it was trading at 0.1 times sales. And Ryan Cohen was sniffing around, and I said, man, this guy could get this company growing. That would be the second part of the equation, but the first part of the equation is a ridiculously low price to sales, and so we bought that. Amazon is another one that, I mean, it's traded around 2.5 times sales, which is a great price for them. Right now, they're about 4 times sales, which is a little bit high. It's on the cusp of high, but it's a great company. Now, the ones we want to stay away from are ones like maybe Zoom, which is at like 25, 30 times sales, or some of these really hot ones are they're obvious, right? They're like, yeah, these things are growing like crazy. Jonathan, why don't you buy it? And the reason is that price to sales is scaring me away. So those are two ways to help identify companies with amazing growth. And I actually ran a screen, and it was just that. Revenue growth over 20%, price to sales under 1.5, and I screened down to about 10 companies, and there were companies that most of them I really didn't recognize by name. A company called EXPI World Holdings, B. Riley Financial, Carvana was on that list, a bunch of them, and that portfolio in a year was up like 200%. I dabbled in that portfolio a little bit, but didn't make a huge position in it. But it was just those two metrics right there. And so a lot of the companies in our portfolio, that was one of the drivers for why we bought them. High revenue growth, low price to sales, not worrying too much if it's not showing a lot of earnings yet. And I think that's a good place to look for potential 10-baggers. So I'm going to stop talking about investing and enjoy the rest of the day here on the lovely island.